Hello, guys, and welcome to the show this evening. I'm going to talk about Italy. I'm going to talk about Europe. I'm going to talk about the United States and the upcoming crisis. And I'm going to talk about some details about it. We all hate the central bank, the Federal Reserve. They're corrupt, they're run by the banking system. They're basically a criminal cartel that basically works for the banking system. But the thing about it is they do have a tremendous amount of control over the United States' financial system. And this control is what's going to actually ultimately help us through this crisis, is this control aspect. Where the European Central Bank and the way they put the euro together is a mess. Now, the United States banking system and the Federal Reserve is organized compared to the European Central Bank. And this is one of the reasons why when this crisis hits, there's going to be a lot of trouble. Now, let's talk about Italy for a little bit, and we talk about Deutsche Bank. Deutsche Bank just cut off 10,000 employees, and the reason why is Deutsche Bank's going down. Let's get real about it. We're in the final stages now. Actually, it could begin, the final slide could begin, and if investors don't come in and pick up the stock, like last time she slid down to like 9 euros and something, 9 euros and change, I guess it was 9.80 or something like that. And investors came in. And also Deutsche Bank was able to dilute their shares, which the shareholders must have just loved that. Anyway, they're able to save themselves. But this time, they're on a slippery slide to hell. This time, they're going down. And it's just a matter of time before all of a sudden everybody starts to get the idea that they're going down. It finally dawns on everybody, and they stop buying Deutsche Bank stock because they get frightened. It's just a matter of time. Now, Deutsche Bank could create a tremendous systematic shock in the system, but there's also Italy. Italy is a tremendous problem. Let me just read an article here. It says European stocks climb as Italy tensions ease for now. You know, Italy is going down just like Deutsche Bank. And I don't understand these investors and stuff. They'll get a little bit frightened, but then they're right back in the pit again. And it doesn't last very long. It's almost like they're a bunch of imbeciles. They see what frightens them, and 2 hours later they are back at it again, and they're not frightened anymore. It's weird. It's just weird. It's totally weird. But the fact that they like today, take for instance the stock market. This morning when I did my show, I talked about the stock market, and I figured it was going to end up a little bit today. Well, Donald Trump come on board, and he said that he wasn't going to make a deal with Kim Jong-un. It's off. And the war drums start to beat again immediately. And so what happens? Well, we get a 150 point plunge in the stock market from that news. But all during the rest of the afternoon, it started to rally back, and it rallied back half of the loss. Because it's like 2 hours later they forget, and they're buying back again, and it's like it's absolutely ridiculous. But why I said that the stock market would probably end up today was because of the bond yields have been falling. Not falling, bond yields have been rising. The bond has went up from the 10 years went from 3.10 back down to 2.97 or something like that. The yields have fell, and the yields have been falling a little bit today, and that's why I expected the stock market to respond to that. And that's why I said this morning I thought it would. Anyway, I'm getting sidetracked. What I want to talk about is Europe, and why it's going to be so bad in Europe is because Europe is a boiling mess. You got the pigs countries. You've got Portugal, Italy, Spain, Greece, and so on. And these guys are already broke. They're already bankrupt. They're so far in debt, it's unbelievable. The Italian banking system is 300 billion euros in debt, over 300 billion euros in debt, and the Italian government just bailed a bunch of the banks out, and they're running on this borrowed money that the Italian government now is so deep in debt they don't know what to do. And so I read this again. It says European stocks climb. There's no good reason for them to climb. It says as Italy's tensions ease for now. It's just sick. It says European stocks moved higher on Tuesday, with Italy remaining in focus as the country's president considered a candidate put forward by Eurosceptic Alliance to lead their coalition government. What are the markets doing? The stocks in Europe 600 index rose 0.3% to end at 396.94, its highest close since January 2019. It's like right now we're in this strange period where bad news makes markets go up and good news makes markets go up. The markets are so manipulated right now, it's absolutely unbelievable. But, you know, you have to understand, the Fed has entered into a massive tightening schedule, and they're not going to stop on this until they get a crisis. Now, when this crisis comes, the United States is going to be somewhat protected, where Europe is not going to be. And this is where I'm getting at the start of my talk, is about the Fed. The Fed is going to a certain degree, it's going to protect the financial system in the United States. It exerts tremendous control over the financial system in the United States. And with a little pause, with a little credit freeze, possibly brought on by a crash, a systematic crash similar to 2008, except more severe, the Fed will basically shut everything down until they can respond. And when they respond, they'll get everything back up and running again. I have no doubt about that. They're not going to leave things down for very long. So it's when the Fed comes back and responds to this, it's that response that's going to ultimately destroy the dollar. But that destruction of the dollar is going to begin with a real financial, in the United States, it's going to start in the United States as a real financial recovery. And the problem is Europe is going to be in mid-meltdown when that occurs. Because when this financial crisis actually hits all over the world, this deflationary event that the Fed's going to have to respond to, it is going to upset the apple cart in Europe at that particular time. Europe is going to be triggered by that financial crisis that's going to strike in the United States. And basically the banking system in Europe is going to have a meltdown. They're going to have a credit freeze too, just like the United States. Except they're not going to have the Federal Reserve to come into the rescue to freeze everything and then to inject liquidity into the system to get the system back up and running again, like in the United States. Europe's not going to have that luxury. The banking system is going to freeze in Europe, and it's going to stay frozen. Can we all say massive crisis like the world has never seen before in Europe? This is the trend I see developing for Europe, especially in countries like Italy, Spain, Portugal, Greece. It's going to be a massive crisis there, because I don't think that their central bank is not, the European Central Bank is just not going to be able to pull all those countries together. They're not unified. See, the United States, get the word I just said, United States is united. We all speak one language here. Basically, it's all one country, including Canada. I mean, okay, they got a border here in Canada and everything. We are a different country, but more or less, we are more closer to the United States as a country than these little European countries are to one another. I mean, they used to fight back and forth. France used to have wars with England. And all. I mean, it's just craziness over there in Europe. They always used to fight back before they became a European Union. So they tried to become a European Union, like the United States is. The United States is united, the European Union, but the European Union is not put together with strong glue. Then this is the problem. There's divisions between all these little countries. All these little countries used to have their own currency. And I mean, some people might get upset at me calling them little countries. But in my mind, the European countries, like Greece, Portugal, Italy, Spain, and so on, are small countries. And they're all in a tight little area, right in that area. And they could erupt into fighting with each other just as quick as they are forming into a European Union. And the whole thing is just put together out of it's like trying to build a house out of mud and rocks, and not building it out of brick and mortar, but building it out of mud and rocks. The first rainstorm that comes along, the whole thing's going to fall apart. And this is the way with the European Union. It wasn't put together properly to begin with. I mean, you got some of the countries there who are, let's just say, they're not good at spending money properly. I mean, they're not savers. They're countries like Italy and Spain and Portugal and stuff are not like Germany. And so Germany had good credit. Germany extended that good credit out to Portugal, Spain, Italy, and so on, and with good faith that they wouldn't abuse their credit, and they gave them the ability to borrow money on the cheap. And boy, gosh, did they ever borrow money. And so now who's going to pay all this back? Well, the European Central Bank is on the hook for all of this. So, quite seriously. The whole thing is it's a tangled mess. It's unbelievable, and it's getting ready to break apart and go down. Now, what's holding it together is it's like bubble gum and elastic bands that are holding this thing together at this point, and a few paper clips, rubber bands, and bubble gum glue is holding this thing together at this point. And so when the American economy actually falls apart, the European economy is going to fall apart too. But they don't have the luxury of a central bank to pull it back together again. Now, when the central bank in the United States actually pulls this all back together again over here, we're going to have an economic recovery, because they're going to have to inject so much liquidity or money into the system this time to actually bring it up. So the harder it goes down, it's almost like a ball. If you throw a ball at the ground, the harder you throw the ball at the ground, the faster it's going to come up the other way. Well, that's the way with this economic crisis. The harder it goes down. Now, in 2008, it went down with considerable force, but it wasn't enough force to make it bounce the other way hard enough to cause a hyperinflation. This time, it's going to be a much stronger effect than 2008. A factor of maybe 10 times more energy than 2008, because they've put this off so long, and their credit expansion has been so huge. This time when the ball falls, it's going to fall with considerably more force than 2008. So on the other side of that, when it bounces back up, it's going to bounce up with considerably more force, because the amount of energy it's going to take the Fed to fix this or repair the problem is going to slingshot it past. Now in 2008, when they had this exact same problem, and the Fed responded to it, they did slingshot it too, and everybody thought that they were actually going to cause a hyperinflation. An awful lot of these guys were out here and they were saying, okay, the hyperinflation's coming, the Fed's causing it. And also that recoil effect caused silver to go up to $50. But they didn't do enough the Fed, to cause a hyperinflation. They only did enough to bring it up to the line of deflation and inflation, a little bit above, maybe create a slight bit of inflation, but more like stagflation. But they didn't really push it so far as it would cause a hyperinflation. Confidence was not lost in the dollar at that point. But this time it's going to be a different story. This time it's going to go down with such force, going to come up with such force, it's going to shoot beyond that area, and it's going to enter into the hyperinflation zone. But to do that, it has to go through an economic recovery zone. So let's talk about that economic recovery that's going to come from the Fed respondent and what's going to be happening in Europe at exactly the same time. Well, I can tell you right now, the trend is that Europe is going to be in a crisis like the world has never seen before, because the European Union is still going to be responding to what happened, what the Fed did, basically. And then here in the United States, the Fed will have responded, and they will have actually pulled us out of our crisis. So at the same time, we're going to be having an economic boom, an economic expansion. Europe is going to be in a terrible crisis. Terrible, like we've never seen before. We're talking about actually people starving to death in Europe. So our crisis is going to come, okay, and we're going to have a lot of trouble. But we'll make it through, and we're going to go into this economic recovery. It's the second part where we're going to have our problems. A few months further down the line, maybe a year out. So we're going to have our economic recovery, and then what you're going to start to see is inflation start to set in, hyperinflation start to set in. And then what's going to happen is confidence is going to be completely lost in the dollar. And what's going to happen then is we're going to go headfirst into the hyperinflation. And we're going to have our starvation during the hyperinflationary depression that's going to come then, later, when the dollar completely loses its purchasing power. And then we have to make a transition over into cryptocurrencies just to survive. Cryptocurrencies, gold and silver, just to survive. And the upper limit of the price of what cryptocurrencies, gold and silver, could go to at that particular time, when the hyperinflation comes finally to the dollar and the dollar dies, the upper limit to how high these things could go, well, there is no real limit, because you're not going to sell them for dollars, because we're not going to price things in dollars anymore. But again, the Fed is going to come to the rescue by creating a new type of money. They're going to scrap the dollar. So it's going to work like this. We've had say you're into the future now. I'm going to move you maybe a year or two into the future. And we've had our economic recovery brought by the Fed when their stimulus programs. Things like guaranteed income for all Americans. Things like tax rebates for all Americans, and so on. They've stimulated the economy. They've actually brought an economic recovery, and now we're in that spot. And the dollar, every time you go to the grocery store, you see prices just shooting through the roof. At that particular time, you're not going to want to hold your money in the bank, but there's going to be no way out. Because if you go then to try to buy silver, there's going to be none for sale. You go to try to buy gold, there's going to be none for sale. Quite seriously. And not for dollars, at least. Maybe you'll be able to buy it if you got some Bitcoin. But Bitcoin's going to be going up too, by the way. But there's going to be, the dollar's going to be going down. It's going to be like on an elevator going down to hell. And if that's all you've got in the bank and you're stuck on that elevator going down to hell, nobody that's on the elevator that's going up is going to want to let you in the door. In other words, if they've got silver, if they've got gold, if they've got cryptocurrency, and their elevator's going up in price every week, why on earth are they going to sell any to you if all of you got dollars? And so you're going to be on the elevator going down with everyone else at that particular time. And so how high, this is the rally in silver and in gold where you don't sell for dollars, no matter how high it goes. Because ultimately the dollar is going to go to zero. And a zillion times 0 is still 0. But at that particular point, when it hits a certain point where it's almost completely destroyed, the dollar, the Fed's going to come to the rescue again. And basically what they're going to do is invent a new dollar. And quite seriously, okay. All right, I'm back, and this is part 2 tonight of this talk. And I was talking about the Fed. And one of the things that a lot of you guys maybe not actually, I'm going to go over it really in detail. The part where I say that we're heading toward an economic recovery. Well, one of the things about it, why it's hard to understand that is because I also say we're heading toward an economic crisis. And the two don't seem to go together. First off, how can you have an economic recovery from an economic crisis? Well, let's look back in our past to understand this, how this actually functions. Back in 2008, we had an economic crisis. And what it led to what I'll call a almost economic recovery. And an awful lot of them were touting the words economic recovery. Well, we're in an economic recovery. That's because we almost did make it to an economic recovery by the response of the government, of the feds and everything, the Federal Reserve. Here's the thing, we come so close, and we also come so close to actually having a hyperinflation. It was this stimulus that they did. If they had made it bigger, bolder, brighter, if instead of $80 billion a month, if they had done 150 or $200 billion a month, if they had charged the banking system and did more rounds of quantitative easing, if they had lowered interest rates down below 0, right? Instead of ZERP, if they had done NERP, or am I mixed up? Maybe it's the other way around. Maybe it's ZERP is zero interest rate policy. NERP is negative interest rate policy. So yeah, if they had done NERP instead of ZERP, I mean, just the stupidity of me even saying NERP and ZERP. How stupid does it sound? It sounds almost like that girl that goes through the looking glass and there's those two twins, Tweedledee and Tweedledum. You know, NERP and ZERP. Two twins, NERP and ZERP. Anyway, here's the thing. They stimulated, after the economic crisis, we had that slowdown in that crisis. They stimulated it almost. A lot of people thought we were going to have a hyperinflation. It's that stimulation. It's that the economy picking back up again and heating back up. That's what causes a hyperinflation. But there's a couple reasons why after 2008 we didn't have a hyperinflation. One of the big reasons was something called a liquidity trap. This is what caused the velocity of the money to slow down so much. They expanded the monetary base or monetary supply greatly. But all of that money was sitting and not moving. It had to move. See, velocity of money is how fast money moves through the system. How many times is it spent during a day? How many times does it move? Well, when the money is sitting in a bank account or sitting in an account or sitting in a bank as Tier 1 capital, it's not moving. It's just sitting there. That money has a velocity of 0. The larger that amount of money is, the more it affects the overall system of money or the pool of money, the slower it makes the velocity of money go down. This is why the velocity of money fell off, is because tremendous amounts of money were poured into the banking sector. It didn't move. It was made its way into the system, but it sat there. And a lot of it's still there. And this is why the banks are able to pass these stress tests and stuff. Because a lot of that money is still there. It hasn't been lent out through the power of fractional reserve banking, which multiplies it actually more than by the power of 10, more than 10 times the multiplier. So when this next crisis hits, this is going to be liquidity drying up in the system, similar to 2008. And it's that response this time that's going to actually create an economic recovery. So initially, what we're going to see here in America, because we have a federal bank that can print unlimited amounts of money, we have no restraints. There actually is no restraints. They say, oh, they won't do it. They wouldn't dare do it. They're not going to do bailouts this time. They're going to do bail-ins. Don't kid yourself. They're not going to do the bail-ins. The banks know better than to do the bail-ins. They know that every creditor to the bank would run right in and want their money out of the bank, and they don't have that money. They don't even have 1 penny on the dollar to give you of your money if everybody comes in and wants their money. They don't even have 1 penny. They don't even have a fraction of 1 penny in physical money. See, there's a difference between the money that they show on their books at the banks and actual physical cash that you can actually hold in your hands. What's been actually happening is, if you go back to the 1970s, there was a lot of physical cash in the system because we hadn't used money so much digitally as we use it now. Say you went someplace, say you went to Kmart. Back then they had Kmart. Now it's Walmart. But say you went to Kmart back then in the 1970s and you were going to buy something. Chances are the person that was in line in front of you was going to pay cash. There was about a 99.9% chance, if it was 1975 all over again right now, and oh God, would I love it to be 1975. Seriously, I hate this shit that we've got now, and excuse my vulgar language, I don't use expletives very often, but I mean, let's face it, folks, this system that they've created, trying to make everything easier for us, has only made things harder and harder and harder. But chances are, back in the 1970s, the guy in front of you would pay cash. And so the available cash that people used, because they had to use it more, there was more available. There was more cash floating through the system. People had more cash in their pockets because that's what they had to use. They just couldn't go in and use a debit card. Debit cards didn't exist yet. With this computer age and computer system we have now we have the debit card. So what's happened is money is moving. Much of the money has become digital now, and only a very small fraction. So if you go back to the 1970s, say we had this much cash in the system floating around, real honest to God cash. That's dwindled now. It's down like this. It's a little tiny sliver. We only have a little tiny amount of cash now floating around in the system. So now what happens if we have a crunch and everybody decides to come in and they all want their cash all at once? They want it because if you're going to make a withdrawal from the bank, let's face it, you're going to want it in cash. How do you withdraw your money from the bank if you don't withdraw cash? So sure, if the people get nervous about the banks, they have every right to come in and say, hey, you know what? I want my money. Give me my money. And the bank, they can fool around, shuffle from one foot to the other, tell you why they don't want to give you your money, but ultimately they'd have to give you your money. And if everybody come in and wanted their money, how much cash is available in the system right now because of deleting the supply of cash? There isn't hardly any. You're not going to get your money. They know this. The jig would be up for the entire banking system. They know this. The jig would be up. So what they have to do is they can't do bail-ins because there would be runs on the banks. People would get nervous and they'd run in and want their money. They've got to do everything they can to keep you thinking that they are a stable system when they're not. There's no stability within the system whatsoever. This is why in the banks they do not like to show you their screen. The tellers do not like to show you their screen. And the reason why is because when you see their screen, you suddenly realize that your money doesn't exist in the real world. It only exists on their screen. It's just the same thing as World of Warcraft gold. That's what your money is. It's just a digital commodity on the screen that doesn't exist in the real world. The amount of cash that they actually have on hand is so tiny, it's such a tiny fraction. If everybody wanted their money, they're pulling the same old routine as the banks pulled when they first started, and they first started giving IOUs for gold, and people started to use the IOUs as cash or money, and they put more IOUs into the system than they had actually gold on hand. The bankers did, the goldsmiths. What they started with as goldsmith or Goldman or Goldsmith. And then they developed into these banking systems. And honest to God, these guys who figured this out, they figured out the biggest criminal racket in history. But it's going to be coming to an end pretty soon, and they don't really understand exactly how to stop it at this point because of the cryptography system that's coming in to take the place, and it doesn't need a middleman or a third party. Like every time you go to a store like Walmart or Kmart or whatever, and you take out that debit card, it simulates a two-party transaction between you and the teller. But actually it's a three-party transaction because it goes and the bank has to approve the transaction, and then it immediately comes back to the store and it simulates a two-party transaction, but it's actually a third-party transaction. This is going to be done away with because cryptography is not a third-party transaction. It's actually, the cryptography is taking the place of the bank. The math in the computer is taking the place of the bank, and they're going to make the banks superfluous because everybody can become their own bank as soon as they download a wallet, a cryptographic wallet off of the internet. So anyway, getting back to the topic of this discussion right here, the topic of this discussion is the recovery. People can't understand. If we're going to have a crisis, how are we going to have a recovery? And the recovery is going to be a response to the crisis. So the crisis comes in, takes everything down. The government comes in, props everything back up, but they overstimulate, they over-respond, and they create a crisis, a new crisis. The new crisis is the recovery. But it doesn't start out as a crisis. It starts out as a recovery. And every recovery feels good when it first starts. That's until it gets going. It's like a snowball effect. It slowly gets going faster and faster down that hill. And recovery gets stronger and stronger and stronger until ultimately the recovery is going to tear the system apart. So we're in for a 1-2 punch. First, a deflationary problem that's going to be fixed by the Fed. But now over in Europe, this same deflationary problem is going to run out of control. So Europe is going to be going one direction. And America over here, we're going to be going in a different direction. It's going to get so bad in Europe, I think, that because they're going to be, the system's going to start to break apart. And I just don't know exactly what the answers is, how they're going to get out of all this. They're probably going to have to go back to their currencies, like in France, their currency, and Germany. Germany was the mark. France was what was France? I'm trying to think now. Italy, these different countries had different currencies. And they're probably going to have to go back to their original currencies again. All these little countries, and the European Union is probably going to fall apart and break apart with tremendous upheaval. This is going to be a situation worse than World War II. And at the same time, we've got these other countries in the world, these other hot places, that could erupt into World War III. We got some nasty mess coming up in about the next year or so. I'm going to have to keep my eye on all of this and spot the trends ahead of time as they're developing. It's going to be exciting times. It's going to be exciting times for my channel. And I've got a job to do. And it's going to require a lot of effort, and I'm going to have to stay on top of this situation for you guys. And this is my job, and this is what I'm going to do. I'm going to be with you guys right through the entire crisis, if I possibly can, unless the internet goes out. So listen, thank you guys for listening to this double-part program if I can think of more ways of describing how to go into more detail, but as this situation unfolds, I myself am getting more information and spotting more trends developing. As the bond market's starting to explode, and I notice that it's exploding in pulses, in bursts. What happens is the yields start to rise. They rise to an exceedingly high spot, and then the buyers come in, and then they knock the yields back down again. And so now we're right in one of these periods where the yields have been knocked down. They went up to 3 and 10 basis points, over 3%, 3.1%. And now they've knocked back down under 2.97, I think it was tonight. But don't worry, they're going to go back up again. They're going to exceed the high that they were before. This next time they go back up. But a whole slew of buyers come in just now, and they bought a slew of these bonds. They're going to be so sorry. Stupid jackasses are going to be so sorry. Anyway, thank you guys for listening, and we'll catch you in the next show. Bye.